Right, ladies and gentlemen, good afternoon. I think we might as well make a start. First of all, just a warm welcome to everybody, and thank you very much for sacrificing part of a very sunny Friday afternoon to be with us. So we're very grateful for that. Can I first of all thank our sponsors for this afternoon's event? That's IPOS Mediation and the law firms RPC and Reed Smith. So thanks very much to them for sponsoring, and of course to RPC for hosting us this afternoon. Now, the topic that we're going to be talking about this afternoon, as you know, is international cross-border insurance disputes in a post-pandemic ESG-focused era. So let me just start by introducing our panel. I'll introduce myself first, if I may. I'm Charles Gordon. I am a professional mediator working with IPOS Mediation, and it's a great pleasure to be here this afternoon. On my left is Natalie Graham, who's head of claims at Mosaic Insurance, managing a broad spread of claims across multiple lines of business. Having previously worked in private practice, she's worked in the insurance sector for about 12 or 13 years now, I think. And Natalie brings a 360-degree appreciation and understanding of claims, and also a fundamental understanding of the fundamental importance of a fair outcome for claims. So welcome, Natalie. And then we have James Wickes, who's a partner at RPC, specializing in advising London market insurers on complex insurance disputes. And beyond James, we have Angus Duncan. Angus is the global D&O coverage specialist at WTW, as well as his work as a coverage specialist. Angus is also a thought product leader for WTW and regularly speaks on and publishes papers about developments in D&O liabilities and insurance. Prior to working for Watson Tower, Angus was a partner at 2 international law firms, working with insurers on high-value, complex financial lines claims and on the drafting of their policy wording. And finally, we have Peter Hardy, who's a partner at Reed Smith, heads their London Insurance Recoveries Group, with particular experience in global and multi-jurisdictional coverage issues in the financial services sector. So our focus this afternoon is on international post-pandemic ESG-focused claims, looking to a future increasingly concerned by ESG considerations. What we're going to discuss is how risk perceptions of companies and corporate stakeholders are changing in response to the new focus of the post-pandemic environment. It is clear that the boardroom in general and individual directors and officers in particular, for them, the risk analysis will need to acknowledge this new focus and understand how traditional insurance protection is keeping pace. And we might think that the focus in the last few years has very much been on the E of ESG, environmental claims. We're all aware of climate-related litigation, which has been growing apace in a number of jurisdictions. But today we're going to look across the whole range, environmental, social, and governance issues, seeing how they're linked, seeing how insurers, brokers, and those handling disputes and claims are responding to the new environment that we're all facing. And what I'm going to ask now, I'm going to ask Angus to start off by talking about a very interesting survey that his company has recently done on directors' liabilities in 2022. Angus.
Thank you very much. So WTW, in partnership with another law firm, do a survey annually of directors' liabilities. And this year, we really took it to a different level in terms of the global cover. So we, in fact, got responses from 41 countries around the world this year. So it's a really, really international perspective that we're able to get looking at directors' liabilities. Despite the international nature of it, the actual risk profiling done by all of the respondents across the regions is in fact relatively consistent at the top. So the top 5 risks overall are cyber attack, data loss, cyber extortion, regulatory risk, and then risk of health and safety or environmental prosecutions. And it is quite surprising. Cyber attack and data loss have been the top 2 risks for many years. Basically, ever since we introduced them to the survey, they went straight to the top. We added cyber extortion in this year, and out of a list of 22 risks we asked people to comment on, it went straight into number 3. So it is quite shocking that directors and risk managers, they're saying that the risks for directors, the top risks, are all cyber related. They're all cyber and privacy. And that is actually quite a surprising result, given the number of different risks that are in the list. So you've got things like employment claims, you've got, I don't know what else, economic crime, return to work COVID, climate change, supplier business practices, social engineering crime, bribery and corruption, lots of things that you think are very important. Insolvency ranks really badly every year, despite the fact that I did my first one of these last year, and we were in the middle of the pandemic and everything was still shut down. And people went, yeah, no, I'm not worried about my company going insolvent at all. So quite a surprising set of results. Given that we're talking about ESG, now, actually, all those cyber things, they do fall within the ESG categorizations. And so they are part of looking at ESG risks. But let's also think about where climate change does come in. It's not in the top 5 risks anywhere, for any region, I should say, and it's not in the top 5 risks overall. It is, however, the number 6 risk for GB, Asia, and Australasia. Whereas for the remaining regions, which is North America, South America, and Europe, it doesn't feature even in the top 7. So climate being top 6 is quite good, 6 out of 22. But bearing in mind that the survey was started literally in the middle of COP26, it is quite surprising that there weren't more people saying this is seriously important. And as we'll come on to, bearing in mind the number of new laws that are being imposed and regulations that are being imposed on directors, it is quite surprising that more people haven't seen a focus on climate change as an exposure for directors. I'm conscious that I'm going on a bit, so I will just finish off very briefly to say climate change does make it a top 5 risk if you look at things in industry groupings or by size of companies. So finance and insurance and the energy and utilities sectors, they both rank it as a number 5 risk. And the largest companies, 5 billion plus turnover, those companies do rank it as a top 5 risk. So there is big variation depending on what industry you're in and how large your company is.
I mean, it is slightly surprising, isn't it, given that there is certainly, there have been a growing number of claims in different jurisdictions around the world relating to climate change. I mean, do you think it's going to go up the chart as time goes on?
Oh, I would definitely expect that, particularly given the SEC's recent announcements and the new laws that have come in. I think climate change must be seen as a director level priority.
Yes, yes. Anyone else want to make a comment on that?
I was just going to say, Angus, I don't know if some of the directors may feel that the regulators might be, giving them an element of time to embed some of those new regulations and obligations. I mean, that's what you probably expect, isn't it? Some flexibility in the early stages. So maybe that concern might increase as we get some maybe some examples of where the regulators have come down hard on some companies. I don't know.
Yeah, I mean, these are all very new laws and regulations. So the FCA's rule, the listing rule, that only came into effect essentially for accounts from last year, which means that they were published this year in January from the first time. So it's not surprising we've yet to see somebody coming and dealing with whether or not there was compliance with that.
But the FSA has, as recently as this month, gone out publicly and talked about how it's looking to force the pace of change, particularly on diversity and the introduction of diversity within boards and senior management levels, and how it's looking to chase the laggards. I mean, that's a phrase that both NASDAQ and the FCA have used in relation to looking to implement new rules around sort of a structure of boards and structure of senior management teams, which I think is interesting. So yes, they may be giving them time, but I think they're on the case at the moment. And I think they're publicly going out there. You can pick up their bulletins, and that language is in those bulletins.
I guess that's a question for Angus, but the report has emphasised that climate change in particular doesn't necessarily feature as high up the list as you would necessarily expect, but it is up there. It is something that people are referring to as a concern. I mean, I don't know if the report covers this, but there's something being a concern, and then there's actually doing something about that concern. And I think it would be interesting to see to what extent those concerns are then resulting in meaningful action being taken, as opposed to statements of intent and the like. And I guess that kind of ties into something that we'll talk about later on, which is about, you know, what is everybody doing about it? What is the insurance market doing about it? What should boardrooms be doing about it? So I think it still feels, you mentioned that cyber was on the list for, you know, has been on the list for a really long time. But I think it's only relatively recently that people have actually really begun to grapple with what that actually means, and the fact that it isn't enough to be concerned about it or aware about it. You've actually got to be taking steps to address it. And I think the main issue is that people just didn't know how to do it. And I think that's probably also true when it comes to, you know, this broad, really, really broad kind of ESG. You know, I think everybody knows, okay, we're supposed to be concerned about ESG, but, you know, what does that really mean, I guess?
And I think on that topic, it's really difficult if you see it as one topic.
Yeah.
How do you manage ESG? It is a massive conglomeration of various different risks. You can't manage ESG, you can manage all these different risks and then say ESG is a way of looking at how well managed your company is.
100%.
It's like I think you alluded to earlier, the governance part. I mean, that encapsulates a lot of those other risks, doesn't it? So,
well, governance in many ways is governance of all of the other risks.
Exactly. Yeah.
Sorry, I think there's
Now, yes, what I should have said is, as far as questions are concerned, obviously those who are in the room, please put your hand up if you want to ask a question. And those who are have dialed in, are listening in, we do have the facility, the chat facility. So please let me have any questions that you might like to put to any of our panelists, and we'll bring those in when we can. But there was a gentleman with a question here.
My name is Thomas. I'd just like to ask whether we have a large enough sample group for those rankings that you produce. Some of the risks you talk about are old risks. ESG is relatively new. You'd expect, if it was only compiled since COP26, which is what, a year ago at max, that ESG is only beginning to come up the rankings, and potentially will land up much higher than that. We've also had the Shell judgment in the Netherlands, which we're all aware of.
Yeah.
That is going to be major in a longer term. And as other people jump on that bandwagon, probably the E part of ESG is going to potentially become really very major for the oil companies and the natural resource companies.
So I totally agree with you that it is, obviously it's a developing area. In terms of your actual question about the survey, we don't ask a question about ESG. And we didn't, because at the time we were writing the questions, we thought this still isn't one risk. So there's no point in asking people to comment on how you judge, you know, how significant do you think ESG is as a single topic. So we asked about climate change, and indeed we asked then 3 questions about climate change. But the point of the survey is not to say we are experiencing claims in relation to climate change. We do actually ask about various claims, but not climate change ones as it happens. So we ask about cyber, for example, whether you've had a cyber claim in the last year. But in terms of climate, we ask those people who responded to the survey to say, yes, I think climate change is at least significant. We then ask them to categorize 3 other different subcategories of climate risk. So we ask them to say, how significant do you think physical risk is? How significant do you think transition risk is? And how significant do you think climate change reporting requirements are for directors? So it's not meant to be saying we are experiencing claims. It's meant to be, this is on our agenda. This is what we think is risky for our directors. So it is subjective, totally subjective. That's what it is as a survey.
And I think it is worth just emphasising, I think I'm not necessarily following any necessary, it is on.
You're on.
Any necessary order. But it's been mentioned already that, you know, ESG is about so much more than climate change. And you know, from my perspective as handling claims for an insurance company, particularly, for example, financial institutions claims, this is about kind of risks to the boardroom. You know, the S and the G really, really are very significant. The FCA, for example, has expressly said that it is concerned, and it will launch investigations and it will take action in relation to non-financial misconduct, for example. And so that goes to issues such as culture. The FCA have said that, you know, a poor culture is indicative of it's indicative of it's a risk. Any company that has poor culture, victimization, bullying, is not that is not focused on diversity and inclusion, it does present a risk to investors and financial markets. So, and that isn't just a risk to individual directors either, that is a risk to the organisation. So I'm dealing with a matter at the moment where there is a particular individual the FCA is investigating in relation to historic allegations of sexual misconduct within the organisation. But in addition to that, they are also looking at how the firm handled those allegations, the steps that they took in response to those allegations, and essentially whether the culture of the organisation really encouraged people to come forward and to believe that their concerns would be adequately addressed. So, you know, I think it would be dangerous to think, well, you know, there's this talk about ESG, but that's just, and in this post-pandemic world as well, culture is increasingly important, not just to the FCA, but to employees, to firms. People are, you know, really, it's people are moving because of culture. And so that is really, really rising up the ranks when it comes to, you know, the importance for regulators, for employees, and it should be for boards as well.
And even, I mean, in a sense, I mean, the climate change issues are really around governance, aren't they? Because in a sense, we don't necessarily criticize people per se, oil companies doing what they do or whatever. It is a matter of how they are governed and how they respond to changing circumstances and what they disclose to the public and shareholders, etc. Shall we talk about claims and what people are seeing in terms of claims in these different areas? James, would you like to start us off on that?
Yeah, I think I wouldn't say we've seen you know, a big wave or tsunami of claims or anything like that at the moment. But what we are seeing, I think, is let's just take you know, the UK as given its London International Disputes Week as the kind of focal point. I think what we've got is a fairly sort of fertile ground for claims coming, where you know, where the circumstances fit the legislation that we have. And I think the area I would just focus on is lots of different types of claims that could be made against individuals and companies in this area, such as, you know, regulatory actions, criminal actions. But I think just focusing on shareholder claims as an example, if you just go back even, what, 6 or 7 years, you didn't really see the UK as a big shareholder sort of securities action jurisdiction. But we do have a number of those claims now in the system, probably off the back of, you know, in the prospectus liability context, the RBS claim, off the back of the credit crisis, and then in the context of the kind of Section 90A FISMA type claims off the back of the Tesco case. You know, we've now seen funders looking at those claims, investing in that area in this country. And I think people tend to think that, I think climate change securities type claims in this country are not a real thing. And I think actually when you look at the framework that we've got in place, it's absolutely fit for purpose to bring those claims in this country. I think the thing that that probably protects defendants, I'm looking at it from a defendant's point of view, given my role, is actually to bring a Section 90A type claim in this country, which is very much looking at, you know, shareholders that have suffered loss as a result of untrue or misleading statements in, you know, published information such as accounts or annual reports. The bar is quite high from an evidential point of view in this country. You have to prove that effectively a director of a PLC has acted dishonestly or recklessly in making those statements. It's very much higher bar than the negligence standard that we see in prospectus liability type claims here. And so we do have that high bar to get over in this country, which is, you know, slightly different from other jurisdictions where these claims have been more, I would say, yeah, more prolific. But nonetheless, I do think that that it is an area that will see more claims. In particular, I think because the requirement to bring such a claim in this country does require the shareholders to demonstrate loss. I think where we're going to see it more is in those types of corporate scandal, regulatory findings, that most of the shareholder claims in this country have come off the back of big regulatory enforcement actions, DPAs, that type of situation. So I think that's where the most fertile ground is, I think, for those types of shareholder claims in this country. And I think as the gentleman alluded to earlier about the Shell claim. We've obviously seen the derivative claim in the press over the last couple of months being brought against Shell's board of directors in the UK, which is, I think, the first of its kind, and may well set a precedent for similar claims to be brought in the future. Don't know if anyone else has got any views on that.
I think there is a trend, isn't there, in the US that you're right, I don't think has yet flowed over here, but it's a very visible trend of shareholders effectively saying we invested on the back of disclosures, statements, promises that you made in relation to your practices, and you plainly haven't done that, and our investment has suffered as a result. Now, there is enough of that going on in the US for it to get attention over here. Yes, you've got to convert that to an English environment, but yeah, there is enough of an attention, I think.
And one of the things that's, I think, put a lot of claimant groups off bringing these types of claims in this country is there is a requirement here to prove reliance on the untrue or misleading statement. Now, in the US, you have the kind of fraud on the market doctrine where individual claimants don't have to establish reliance. Now, what I would say in this type of area is that I think it's actually going to be more attractive for claimants in this type of context to bring the claims compared to, say, your typical financial misstatements type shareholder claim, because if you are an institutional investor who has a particular ESG focused mandate or ESG objective, or your stakeholders require you to be invested in certain type of investments, and then it turns out as a shareholder you find out that the company you've been invested in has been greenwashing that type of situation, it's actually you're going to be able to point to your investment mandate, your investment objective, to say, well, of course I relied on those statements because I couldn't have invested in this company otherwise. So that's one of the areas why I think ESG shareholder litigation will kick off in this country, because the two high bars, one of them being reliance, is probably not that high in that context.
But actually also because it will be institutional investors and potentially pension funds. So pension funds have also had a new law requiring them to make disclosures in connection with and to look at their investment portfolios for their climate-related characteristics. So you have to take that into consideration in your investment decision-making as a pension trustee. So pension trustees, bearing in mind that pension schemes are the largest investors in the world, they control a huge proportion of the market. Those people who are being required to say openly, we are looking at climate change in our investment portfolio. Well, if you then find out that somebody was lying about their investment characteristics and you've invested lots in, that means you therefore have been lying to everybody as well. So potentially there could be that institutional investor as the potential claimant, which is how in the UK you need claims to be brought, because you need them because of our costs rules. You're going to have institutional investors rather than just group litigation. I think is still quite hard for shareholder claims here.
Yeah, we might talk a bit about group litigation later. James, you mentioned greenwashing. What is it, and are we actually seeing any claims?
Yeah, I mean, we are seeing greenwashing claims in lots of different jurisdictions. So what is it? I think I tend to, I mean, it's not limited to the financial institutions context, but probably easiest explained in that context. So, imagine you're a fund manager that is marketing a fund as being a sustainable fund or a green fund, and there's lots of different catchy hooks to get this whole swathe of investment money that is ready to be deployed into these types of sustainable funds. There is, I think it's fair to say, a fairly openly accepted point of view that a lot of these funds don't do what they say on the tin, and there's been enough people both internally at fund managers who have kind of blown the whistle on that, some sort of head of sustainability type people that have left companies because they don't like having to lie effectively. So there's been a lot of that, but we've also seen a number of incidents across different jurisdictions in Europe, US, Australia, where regulators are holding companies to account. I think one of the most high-profile ones was the DWS case in Europe, But that's essentially where we are now. Some commentators are kind of describing it as the next big mis-selling scandal. And what's interesting is that the asset management industry, especially in this country, has never really seen a mis-selling scandal. We've seen it in the banks, we've seen it in pension companies, but it's quite a new risk for the asset management sector. But I do think it's there. I do think it's real, and it will only, I think, become a bit more easier to manage for those companies once the regulations start to come in and we get a kind of uniform taxonomy about what does sustainable mean, what the types of words that they're using to market these funds. At the moment, they don't have any kind of definition, and so that greyness is going to, I think, lead to a period of quite difficult regulatory and compliance for some of these big, large financial institutions, and obviously a big concern for their insurers.
Thanks,
I mean, from an insurance, well, not from an insurance perspective, from any perspective, it will be interesting to see how those types of claims play out. And I do agree with you that I think that they are coming and they are on the horizon. But if you're looking at investors that have invested in some fund on the basis that they are sustainable and it transpires that they're not, there is still the question of loss, I suppose. So I think there will be challenges in establishing that the kind of the breach has actually led to any loss. So I suppose it may only be in relation to those underperforming funds, or else there will be more imaginative arguments, I suppose, that are raised. But just to pick up on an earlier point that you made, I can't emphasize enough how often we see that the claims, whatever those claims look like, whether they're securities actions, whether they are Section 90A, they do so often come off the back of some kind of regulatory investigation or determination, or I've seen them coming off the back of criminal trials. So where there has already been a determination or an admission that actually things were not as they ought to have been, then the claims follow. So I think the fact that, excuse me, when it comes to climate change, disclosures are now going to be mandatory, or now mandatory as opposed to voluntary. So that's a huge shift. And that does give the regulators themselves something really to hang their hooks on, I mean, and that's obviously around disclosures. But I think that is just the start in terms of what the regulators expect. So at the moment it's around disclosures, but I anticipate that in the future it will be about, actual action. But where the regulators go, other types of claims tend to follow, very much so.
Thanks, Natalie. Peter, can you talk to us about reporting obligations?
Yeah, I sort of mentioned a case at the end of last year called Berkshire Assets and AXA, which James may know differently, but I think this was the first case on the new standard of assessing fair presentation of risk under the Insurance Act. And it was a reminder, if we needed it, that a failure in that respect, a failure to satisfy the requirements of the fair presentation, can result in the policy being avoided. And I think it's relevant in this context because it's clear, and all the commentators are saying so, that insurers are now consistently requiring information about policyholders' ESG practices and the interpretation of ESG obligations on their business. They're aware of increasing regulator pressure in this regard and direction in this regard. And I think the Berkshire Assets case I thought it was quite a tough lesson in a way for the policyholder. There was no question the individual responsible for making the fair presentation in that case simply did not know about the information that should have been presented to insurers, but was not. His failing was not making enough and sufficient inquiries within the business. And but the information was held to be material, and for that reason, the evidence of the experts at the hearing was found that insurers would not have underwritten the risk if that information had been provided to them. And I think with underwriters in the ESG context, clearly signposting that they're aware of regulator imposition in relation to ESG, they're aware of what new rules are being imposed on policyholders in relation to both diversity and inclusion, as well as climate change. And we'll talk a bit more about diversity and inclusion later. But at the same time, underwriters and policyholders are struggling to measure these risks because it's not easy to do so, because there aren't consistently applied standards for everybody to understand. So I just thought it was worth mentioning that case, because it was a reminder that, you know, you can get this badly wrong. And as we all know, the consequences for failing in this regard, that you lose your cover. You don't lose your claim, you lose your cover. And that can have a big impact on anybody, particularly as we've already established that ESG risks are so multifaceted and so varied and can come into a business's profile in so many different ways.
Natalie, I thought these days it's really the obligation on the insurer to say what they want to be told. Are you seeing a lot of changes in that area in terms of ESG disclosure?
But I'll issue a disclaimer. I think to Peter's point, I think, and also Frank's point, really, ESG is on everybody's radar. And I think that what we are seeing at the submission stage is, and actually we need to be careful not to make blanket statements, because I think it really does depend upon the size of the organization, the sophistication of the organization, the level of broker involvement. So I think that we are seeing very, very different approaches. But when we're talking about the large corporates, they are tending to bring it up. It is included as part of their submission. As preparation for this this talk, though, I saw one of the kind of the ESG packs that was put together and submitted as part of a submission to us. It was 65 pages long.
Right.
You know, there is a huge amount of information in there, and I'm not saying that's a bad thing, but it's a huge amount of information to digest and to understand and to really then apply to the underwriting process. So I think that what is happening is that it is on everybody's radar. Quite how it is, I think, again, going back to the comparison of cyber, I think cyber was on everybody's radar. Underwriters addressed it by, you know, asking questions around, you know, what security do you have in place? And do you have multi-factor authentication, et cetera, et cetera? And then there would be boxes ticked that would say yes, 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 yes. And it's only now, several years later, that people have realized that actually that isn't the way to underwrite cyber. It isn't really telling you anything. It isn't telling you anything about the real nature of the risk, because it's when MFA fails that you get these losses. And so I think that what we're going to see is probably, I think that this is really starting to form part of the underwriting process, but I expect that we will see it really develop over time as people kind of try to take steps to understand, okay, how do I assess this information that is in front of me? And I don't think everybody is quite there yet. There are external tools that can and are used again, but I don't think that there's any real consistency in the way that those tools are being used across the market. But yeah, as I say, I think it's there, it's on everybody's radar, but I think, and because we don't have the claims yet either, again, it becomes quite difficult. I think, I'm not an underwriter, but I think it's difficult from an underwriter perspective to price for something that hasn't actually happened. So everybody is aware of the risk, but at the moment, nobody knows exactly what that is going to look like. And as we said, it's such a broad topic that I think, you know, the market is still in its infancy in kind of figuring out how exactly to deal with this from an underwriting, insurance and underwriting perspective.
Thank you.
Challenge that very slightly.
By all means.
From the point of view of the broking side, I think it is at the moment still being left up to clients to decide what to tell underwriters about ESG. I think underwriters are saying, we will want to know about ESG, and that's probably they might ask very specific questions for a specific client, but we don't have a consistent set of proposal form questions from most insurers. It's not a consistent approach that's being taken. So we're not in that position, even to have a tick box set of things. It's still very ephemeral. It's just, talk to us about ESG, you know, and what you then get is, and what will you do with the information I give you about ESG? Because if I give you a 65-page document, are you in fact going to read it? Are you going to analyze it? And what difference is it going to make to the terms that you offer to me? So I think we're still we're on the same page in that it's very early stages. And I'm sure you're right that it will be like cyber, it will gradually get refined. But right now, it's still very inconsistent, and more everybody will want to talk about it in some way. And in that general way we were talking about at the beginning, we'll talk about ESG and you decide which bits of ESG you want to raise and bring up.
I mean, I suppose underwriting, and particularly when you're looking at financial lines and, you know, directors and officers, it has always been about kind of assessing governance, you know, how is this organization run? That is essentially at the heart of it, and that hasn't changed. It's just that the things that need to be focused on have changed. So I think that, you know, at its heart, governance is still, and you know, underwriting has always been about assessing a wide range of, you know, a whole host of information, and the information around, you know, ESG is just one piece of that information. So I suppose it is quite difficult to say, well, this is exactly what I'm going to do with it, because actually it all goes into a, you know, it goes into a melting pot, and, you know, that's what forms the ultimate underwriting decision. I mean, to your point though, I mean, you're right, it is for the underwriters to determine, you know, what they want to know. But you know, I think it will be interesting to see how that evolves, you know, in the coming months and years, in terms of how information is elicited and how it is then provided, I suppose.
Okay, let's move on a little bit and ask about and look at what is changing from a risk perspective and what types of litigation and regulatory action we might see. Angus, would you say a few words on that for us?
Okay, so I think we've all alluded to the fact there's been lots of new laws and regulations. So we just wanted to take a brief opportunity to talk about what some of those are. I've looked at this within my context at work for the purposes of the UK, the US, Australia, and the EU. So I'll try and cover those in very, very high level ways. In the UK, we already have duties for directors that are completely pertinent to climate change, in particular, under the Companies Act. So directors are already under duties to consider the impact of their decisions in the long term, and climate change is obviously one of those things. But they're also under a duty to consider the impact of the company's business on the environment, which again is kind of an obvious tick box. And indeed, they have recently, some directors have recently been sued, alleging that they are breaching those duties by failing to set what somebody else considers to be a reasonable net zero policy. The PRA has imposed stress tests on banks and insurers. And then since 2020, December of 2020, the FCA introduced a rule requiring, on a comply or explain basis, for all premium listed companies to make a statement about whether they've made disclosures consistent with the Task Force on Climate Related Financial Disclosures. They then expanded that in December last year to all companies, pretty much all listed companies. The UK government, sort of in parallel, but not quite touching, has passed its own rules as with effect from the 6th of April this year. All large companies, whether they're listed or not, so listed companies have to do both, have to make actual mandatory disclosures. So not a statement about whether you've made a disclosure, you have to actually make disclosures in connection with climate change. The UK government says they are based on the recommendations of the Task Force for Climate Related Disclosures, Climate Related Financial Disclosures, but says, therefore, if you comply with the FCA's requirements, you probably also will satisfy the government's requirements, but only probably. So it's slightly uncertain position for people. Then we've got the Pension Schemes Act, which has imposed the requirements on pension trustees that I mentioned earlier. And the FCA has also passed a rule for asset managers, life insurers, and FCA regulated pension providers, who also have to make disclosures in connection with the climate related aspects of their investment portfolios. The EU, since 2014, has had a non-financial reporting directive out, which applies to large public interest companies, and in 2019 published guidance as to how you should do that for climate-related factors. They've now consulting on expanding that significantly to a wider group of companies, not just PIEs, and also to impose audit requirements. And that would be a really big change when you start having somebody have to actually audit whether your publications are accurate or not. And then they also last year published the Sustainable Finance Disclosure regulation, and that imposes wider than just climate change. It's an ESG sort of, it doesn't refer to ESG, but it looks at social and environmental characteristics of financial products. So if your product purports to have a sustainability quality or an environmental quality or a social quality, then you have to make public statements about it. The US, the SEC, just in March, announced that they were they made a proposal for climate-related disclosures to be made in the US. It's actually relatively controversial. It won't come into effect for another couple of years, but it is relatively controversial because amongst their proposals is for people to have to make disclosures about their greenhouse gas emissions, both upstream and downstream. So you're going to have to say what your customers are doing in terms of greenhouse gas emissions as a result of your business with them. And that therefore requires a huge amount of investigation. And it's only for the largest companies that would apply, but it's still a very controversial proposal. And very briefly, in Australia, the Australian Securities and Investment Commission has identified disclosing and managing climate-related risk as a key direct responsibility and has issued guidance to people as to what they should be doing. Basically, so is the PRA, the equivalent of the PRA in Australia. And then the Centre for Policy Development in Australia has commissioned a senior counsel to issue an opinion, which he continually updates. And his opinion makes it clear that people can be sued under existing Australian rules for greenwashing type situations. So that's just a really brief overview. I should also mention, because I've mostly focused on climate change, I did mention the EU is wider than just climate change. The FCA, and I think Natalie alluded to this earlier, the FCA has also passed a new rule just a few weeks ago, saying that you're going to have to make disclosures in connection with board diversity. Correct. And they're not just saying, for example, as the US have done. So NASDAQ has a requirement for minimum board diversity that you say whether you have it or not. The FCA is saying you're going to have to say whether you've complied with certain minimum standards. So you're going to have to say whether you have a board that is at least 40% comprised of women, has at least one minority board member, minority ethnic board member, and also does your board have at least one woman in a senior executive position as well? Correct. So it is not just a climate change related issue. Disclosure requirements are coming for everybody for multiple characteristics of ESG.
And how do these reporting requirements give rise to director exposure? Where are the obvious points where this will lead to actual exposure?
Basically, every time you make a public statement, anybody can sue you for getting it wrong. Now, you've already talked about this, but it does mean regulators can scrutinize what you've done immediately. As far as insurers are concerned, that means the policy potentially gets engaged and it costs insurers lots of money, even if you can justify your position. You've got the potential for anybody to scrutinize what you've said. Particularly, lots of people have been making disclosures on a voluntary basis. And they're going to be in a position now where, having to do mandatory disclosure, people will immediately be in a position to scrutinize, to compare what they're saying now on a mandatory basis with what they said when it was voluntary. So it's that kind of situation. It's misrepresentation claims, basically.
I think they're phrased, aren't they, as breach of fiduciary duties by boards in failing to make changes to diversity principles and management appointments that they say they're going to make and explain why they're going to make. And then you get claimants basically saying we relied upon that. And that's where those claims come from, as I understand.
Yeah, and the company itself, not just the regulators, but that's where the shareholders will just try and step into the shoes of the company and bring that claim, because it's essentially they owe the duties too. But I think what's quite clear is that the increased disclosure obligations means that more than ever directors are going to have to really fully understand their disclosure duties. And as you kind of alluded to earlier, Natalie, governance has been there forever, but it's just new areas, new duties, new disclosure obligations. I do foresee a lot of these companies just getting a real expert ESG focused people at board level because of the sheer nature and volume of the increased onus on them to report.
But all of the commentary that I've seen anyway says that that's just not happening at the moment. No. The percentage of companies, major companies with ESG focused expertise at board level is tiny, single digit.
Absolutely. That point as well, I think, companies I think do actually have. Sorry, but as you say, it's whether the people on those committees have the right levels of expertise and qualifications to really make any kind of meaningful change.
So where a lot of this all starts is with some kind of regulatory investigation. And Natalie, I wonder if you could say a few words about how insurance fits into that, the trigger for cover, because I know that can be quite a a controversial area. Certainly if you're facing those sort of regulations and you're hoping your insurance will engage at an early stage.
Yeah, absolutely. I mean, again, I'll preface it by saying it will entirely depend on the policy wording, and so it will always depend on that, and they're not all the same. And I think particularly now, you know, we're in a much harder market when it comes to D&O, and so coverage terms are changing. But generally speaking, there is coverage for individuals under a directors and officers policy from the point where they are asked to attend at an investigation. As I say, during the soft market, we did see that change and we did see that broaden out. But generally speaking, the trigger for cover is being asked to attend an investigation or to participate in an investigation. The D&O policy isn't there to pay for board members to comply with their day-to-day obligations to, you know, engage with the regulator or to respond to requests for information. That's not what it's there for. There needs to be an investigation. And so, but as I say, some policies will actually respond at the point where there are requests for information, but I think we're probably moving away from that. Certain policies also include what is called pre-investigation cover. Again, I mean, Angus may know, but I don't know whether during this harder market, because the D&O coverage started out quite narrow many years ago and then became broader and broader and broader and broader, and it wasn't being priced properly. And so there's now been a real constriction in capacity and also in coverage. But there can be coverage for pre-investigations, which means essentially, for example, if there is a dawn raid, there's no formal investigation, but there has been some kind of action taken. So a dawn raid, I'm trying to think what the other triggers are. I should have, James, help me out here.
Yeah, no, it is. I mean, that the pre-investigation cover you do see in commercial D&O typically, and it is much, the trigger point is much less of a formal investigation, but it's more, you are required or requested to attend an interview. It's not necessarily a formal memorandum of investigation from the FCA. It's that pre-phase. It is often sublimited. It isn't subject to the full limit, so it's sublimited, and the costs are significant. So it isn't a given that there will be sufficient costs.
I think I would say it is in every policy, but it is often sublimited.
Yeah.
Okay.
And that's the hard market response to it, is to try and sublimit it. But I haven't seen any insurers trying to take it out of the cover entirely.
Okay.
No. But I mean, I don't think it's just me, I think. But certainly I've been having nice scraps with insurers for years about the interpretation of this cover in particular. I don't know why regulatory investigations or however it's worded in policies has triggered so much of a debate about when that starts, but it has. I mean, much more so than in straightforward claims, I think. And certainly so as a policyholder lawyer, I start from the position that D&O cover is, I think, for many policyholders, most essential as defence cost cover. And if you've triggered a need to seek legal advice because you have been approached by a regulator in a certain way, and I'm not talking about day-to-day sort of dealings with the regulator, I'm talking about some sort of approach for some sort of allegation of a failing by a regulator, that should, in our view, be looking to spark a response from a policy. Now, then you get a debate, because I absolutely acknowledge that some wordings don't look like that, and because they're intended not to. But there is a big debate about this area, and I think it's much more of a debate in the investigations context than in the claims context. Would you agree with that?
Yeah, I do.
James?
I think where we might end up in a little scrap
on the other side.
Yeah. It's typically also where the focus of the investigation is on the company, because speaking to a lot of underwriters, their greater concern is covering entity investigation costs as opposed to insured person, and that's because it's just a lot more expensive process. Because when it comes to a big investigation, for example, into a financial institution, if it's into the company and the director, it's the company that are going to face the real burden of that big disclosure of documents, etc. So
there'll be separate representation requirements as well. So
yes, exactly, and
additional advisors on the hook.
Yeah. So if I put it this way, if I was sitting on a board at the moment with all the types of risks that we're talking about, leaving aside the other X number of risk perils that directors are facing at the moment, you would really be, I would think, kind of, negligent to your family not to really understand your DNA policy really carefully. And
Brutal, negligent to your family.
I would
Wow.
expect my wife to give me a right slap if I hadn't read my insurance policy properly.
Interesting idea of the discussion over the dinner table of your DNO cover. But
She
anyway,
won't be watching.
Peter, tell us about current trends for targeting directors.
I think what Angus has highlighted some of the developments, particularly in the US. We've seen regulators in the US and in the UK expand away from climate issues, in particular, into diversity requirements. Both NASDAQ and the SEC and the FCA are consistent in the way that they've dealt with this. I mentioned earlier that there's an FCA bulletin which talks about putting pressure on the laggards. That's language that's used by NASDAQ in their own publications as well. They're clearly going after the same sort of, going in the same direction as far as putting pressure on the policyholders is concerned. And Angus has mentioned that the FCA requirements are very specific about what composition of boards and senior management teams should look like. That extends to all listed companies at the moment. NASDAQ requirements are not the same, but they're similar. At least one director who identifies as female, one director who identifies as from an underrepresented minority or LGBTQ community. That will increase to 2. So that's going to happen. So, and these are both, in both jurisdictions, they are mandatory, but they're comply or explain requirements, and that's how they're looking at it. But I was interested in just doing some research on this. It's not, there is some inconsistency. California was much applauded a couple of years ago for passing new rules in 2020 requiring diversity on boards, and that's recently been struck down by a Los Angeles judge who decided that it was unconstitutional to impose mandated quotas. So it's an area which is still being, I've said this since we started this talk, is being developed all the time in different directions, in different jurisdictions. There is a very consistent theme to the development, but the development isn't consistent across the jurisdictions.
We did see some big litigation kick off against the tech companies on the West Coast at the start of the pandemic, off the back of that, I think. And
shareholder actions that I've noted, Facebook, Oracle, Gap, Cisco, all similar types of shareholder actions where shareholders were relying on express representations made by these companies and saying, that's not where you are.
All bought by one law firm.
Well, isn't that the way? Yeah. Isn't that the way? But they gave them the opportunity.
Okay, thank you. I just want to remind our audience, both in the room and online, if you do have any questions, please put them forward. Either just raise your hands or let me have a message on the chat facility if there's any questions that you do have, and we'll take a little bit for questions at the end. But we're getting towards our sort of final topic, and we've looked at the claims environment, the risks and so forth. Perhaps we could just towards the end look at how insurers are responding to this in terms of the policy language, the policies that are available, new areas of cover that insurers are looking at. And just, Angus, perhaps you could talk about this a little bit from a broker's perspective, and then we'll ask Natalie from an insurer's perspective, talk about that.
Sure. I mean, one of the really good things about directors and officers liability insurance is it's basically really, really wide.
Yeah.
So it doesn't need any changes to make it cover the types of claims we're talking about, these breach of director duty claims or misrepresentation type claims. They're all what the policy is designed to do. They're just in relation to a specific risk area. So brilliantly, we haven't had insurers coming to us and saying, oh, climate change is a bit systemic, we can't pick that up. So at the moment, there aren't any changes being made to policies to deal with climate change. Now, I am aware of some discussions about whether people need amendments to the pollution exclusion if the DNA policy has a pollution exclusion. Most GB policies don't have pollution exclusions. It's more common in the US. But if they do have pollution exclusions, some people feel it needs amending. But in fact, I don't think technically under English law, the pollution exclusion would relate to climate change because they're not they're two long-term issues. I don't know the case law on it, but I think there is a case that deals with that. In fact, we're not seeing a lot of changes needed to policy wordings, and we're not seeing insurers trying to say this is the kind of thing we shouldn't be picking up. So actually all quite good news from that point of view.
Well, we asked ourselves, didn't we, when we were talking about this, whether we thought the wrongful act definition was covering all of the things that we were talking about, and we thought it probably did. But I mean, that's something that is worth thinking. I think it probably does, but the wrongful act definition has been around ever since I've been looking at D&O policy, and it's broadly the same in every single one. So if that's not covering everything, then there's something to think about. But I think it probably does, and I think that we satisfied ourselves and that was right.
Yeah.
I guess the only thing I'd add is, and I entirely agree with Angus, I can't see that there are any particular, well, at the moment, kind of changes that are needed. Say, I'm an insurer, so maybe I would say that the wording is too broad. But we'll see. But I'm aware of one, that there is one syndicate in the market, for example, that has established a follow-only kind of ESG syndicate, which essentially provides additional capacity for their insured that meet certain kind of ESG metrics, and they are independent metrics. So I don't know how this is operating in practice. I mean, it's essentially additional capacity for people that are can demonstrate that they are doing the right thing. It will be interesting to see if others follow suit, or if as I say, I don't really know what the take up is, but it is, that is one kind of initiative that is out there in the market, and I don't doubt that we'll see others. But at the moment, I think not.
That feels like it should be a trend, that effectively showing increasing compliance and increasing observance should prompt a response from the market in terms of what they're prepared to offer, or maybe more limits.
I think that's actually the most interesting question about ESG is, if you do manage your ESG risks well, does that automatically mean that you are therefore a very well managed company and you will get fewer claims? And that is a really out there question, because if you look at some companies who've tried to be very, very pro ESG, their CEOs have been struck off but made to resign for being pro ESG at the expense of profit. Yeah. We've seen companies, try and do the right thing for modern slavery, completely offending people in China who have very different attitude to what they're saying about modern slavery and whether or not that is acceptable statement to make about China, and therefore seeing huge drops in their income as a result of that, or their revenue, because they saw such a backlash trying to do pro ESG. So is it right that if you are pro ESG, you're necessarily less likely to see claims? I think that's a really interesting question.
So that shareholder point is absolutely right in terms of shareholder activism in this area goes so far, but when it stops generating the return that the shareholders are looking for, they're saying, hang on a minute, you're supposed to be making money.
I mean, the syndicate that we were referring to that is providing additional capacity for those with good kind of ESG scores, it's cross-class. So that isn't just for kind of D&O and financial lines, it's across class. And I think certainly when I was speaking to my PI underwriters about this, they did say that companies that can demonstrate that this is something that is really being taken seriously, they do generally have a better risk record because the culture is better, well, for all of the reasons that we've spoken about before. So I think when it comes to certain lines of business, actually a good ESG score is indicative of kind of a better risk. But as you say, but if you're talking about boardroom exposures, not necessarily at all.
I mean, I definitely want to advance that argument on behalf of all of my clients that are managing their businesses well for ESG, but I do, statistically, I'm interested in whether or not it gets borne out.
James, one question you mentioned earlier on about group litigation, and obviously a lot of what we're talking about outside the regulatory environment, if we're talking about litigation, is quite likely to be groups of shareholders or activists or whatever. It doesn't really seem to have taken off yet to a great extent in the UK. Is it showing signs of? I know there are so many restrictions around it that it is difficult from the claimant's point of view to get them off the ground, and then there are all the cost rules and there's funding and so forth, that all those hurdles that have to be got over. But are we, those on the defendant side, breathing a sort of collective sigh of relief that it's not really happening? Or
yeah, I mean, I think that the challenge here again, and it comes back to what I said about reliance earlier, because if you take that out of the equation, you take that subjectivity away from the claimant, right? But as long as that's a hurdle you have to get over, then all the potential class of claimants are in an individually different position. I think that's the big difference here, why securities class actions are just a bit more difficult to imagine getting traction in this country. So and we have seen, so in the Tesco case, they did successfully resist the group litigation order.
Yes.
And I think that was the real basis of the resistance. Although I think group litigation orders did happen in the RBS case. I think you just need that uniformity of damage to the claimant. So maybe one area you could potentially see it would be if it was found that a particular fund had been missold. Then you're potentially all in the same boat. But it's not really a shareholder claim. That's more of a
I mean, the area where it is happening currently, or it is the new process for competition claims.
Yeah.
Right.
And that, even though we didn't mention it, anti-competitive behavior is in the G of ESG. So it is one of the characteristics that falls within ESG. So it is another area where you could see more development.
Mm-hmm.
And James, funnily enough, you mentioned the RBS litigation, which I happen to have been involved in. And just to give a plug as a mediator, that was successfully settled through mediation, despite the fact that there were many hundreds of claimants. So mediation has a role to play even in those type of cases. Now, it's getting up to 5:30. In fact, it is 5:30. So, and it is getting late on a Friday afternoon. So just a last opportunity, if anybody's got any questions, things we haven't covered or things we have already covered, now's your chance to raise any further questions. But if not, then I think that just demonstrates that our panelists have given us a very comprehensive coverage of all the issues, and I'd like to thank them all very much indeed for their presentations. Again, to thank the sponsors for making this possible this afternoon. Thank you all very much for attending. And that's the end of the session. Thank you very much.